I've seen people go from 10 grand to a millionaire in less than a year in this space. Now, you're taking obscene risks in something that's probably most likely to go to zero. But, on a balance of things, I think it's very possible to do it. If you can scrape $10,000 together and invest it not so riskily, you'll do that easily. I think it's 100x return. That's a lot.
In every generation, there comes a once-in-a-lifetime opportunity, a window when the rules of wealth creation are completely reset. For most people, that window passes them by because they're too busy chasing the old playbook. Work harder, save more, and hope the system eventually rewards them. But in the decade ahead, that strategy is doomed to fail. Inflation, money printing, and accelerating technology are rewriting the script. The winners will be those who understand where value is actually being created, in exponential technologies and decentralized assets that are eating the financial world alive. And that's exactly what macro investor Raoul Pal has been shouting from the rooftops. As the former head of hedge fund sales at Goldman Sachs and the founder of Real Vision, Pal has spent decades identifying financial paradigm shifts before the crowd. And today, he says the biggest opportunity of our lifetime isn't in real estate, the stock market, or building yet another business. It's in crypto. Because, according to him, if you can manage to put aside even $10,000, you could be looking at $1 million portfolio before the end of the decade. Pal calls this the exponential age, a period when technology, AI, and blockchain will fuse to form a $100 trillion crypto ecosystem by 2030. It's not a dream, it's math. As capital floods into scarce digital assets, and as fiat currencies continue to be debased to pay off global debt, the value of these networks could multiply faster than any traditional investment in history. But here's the catch. You have to understand how to play the game. In this video, Raoul Pal shares his golden blueprint for investors who are tired of the rat race and ready to build real wealth. He explains how much to invest, what assets actually matter, and why chasing passive income, or meme tokens, is the fastest way to fall behind. Watch till the end to hear Pal's full strategy. And if you enjoy this kind of deep, actionable insight, make sure to like this video, subscribe, and turn on notifications so you never miss an update. Thanks, and enjoy the video.
Basically, you had to buy... I remember when Berkshire Hathaway, Warren Buffett's famous company, used to have a share price of whatever, X $100,000, and nobody could buy it. And he had to have a second version of the share that was cheaper, like a tenth, so people could buy it. So you couldn't fractionalize anything. And sure, Robinhood and people have experimented with fractionalization, but crypto was the thing. Like, you could buy a minuscule amount of it, because I think even within its design, it was realized if it does work, it's going to go to 1 million or 5 million, and you can't price people out of it. It has to be the system that everybody can afford. And this is not just a United States thing. I mean, crypto is literally f***ing people's futures, from people in the rice fields in the Philippines to South America to Europe, all over the world. This is the 600 million users now. No more. It's like 900 million users by the end of this year. And so what you're doing is changing the outcomes for people, where it doesn't just have to be the rich. Sure, the rich can buy this too, but everybody's on an equal footing. So if you go back to that, so let's think of a apartment in Fifth Avenue. It goes up more than other apartments in New York because it's scarce and it's in the right spot. Who can afford it? Nobody, except the very, very, very rich. But the house that you buy in the middle of Ohio doesn't go up. Why? Because rich people don't want to live there, and you can build infinite number of houses in the middle of Ohio. So it becomes an issue. So the rich people own all of these assets. The Berkshire Hathaway share, before they made it smaller, well, only rich people can afford it. But here you've got an asset where everybody can put in 10% of their savings.
Is that your general recommendation?
Firstly, it's actually pretty hard to build a business that grows at 145% a year, every single year.
True.
And I've realized that. I mean, I've got friends of mine who discovered Bitcoin back in 2011, 2012. They've never done anything again. And they're like, people come to me for investments. They're like, show me that it's actually going to do better. I said, do you not build a business? They said, what's the point? That is my point. And if I hadn't sold when I first bought it, I wouldn't have to do anything ever again either. and we can do it because we choose to. My general theory behind this is if you don't have much savings and you're young, put all of your savings into this. And I know that sounds obscene, but this is the only way. So put as much as you can in. If you're building a business, invest in yourself too. Okay, great. So anybody under the age of 30, just go for it. Just don't screw up by buying stupid meme tokens and expect it to 1000x. Sure, you can play around with 10% of your money. Just keep it in like Bitcoin, Ethereum, Solana, Sui, these kind of big networks, and just let it compound, let it do its thing. Don't trade it, don't do anything. Just keep buying over time. It's called dollar cost average. Every month, add a bit more in. And then you can play around with some other stuff because it's fun, and that's okay. You can invest in yourself, and if you start generating more cash flow, then you put more money in. Okay, that's a decent idea. So the game becomes how much can you grow your wages? Can you trade up your job? Can you do a second job to invest as much as possible? As you get older, and we're seeing this now with the millennials, they're all kind of in their mid to late 30s. Okay, they've now got, the big problem is they need to buy a house, they're getting married, and they're having kids. And they realize they just don't have the savings for it. So there's a sense of urgency in that group of people. Is like, we've really got to sort ourselves out. And so they are trying to figure this out. So, we saw them start discovering financial markets in a big way from COVID onwards as they're trying to figure this out.
Many people say that real estate is good for both the tax advantages and the ability to leverage it to buy other properties. Like what's the impact of Bitcoin being able to leverage against that?
Okay, so firstly, let's talk about that, because it's one of the things that really pisses me off is there is a massive online TikTok and probably Instagram trend, which is passive income. It's like this, we all want passive income. There's no such thing as passive income. I've owned many properties in my life. I've had rental properties and houses I live in. They are all a sucking of costs and time. There's always something breaking. There's always something wrong. Your tenants leave. They leave you on the lurch. They've trashed the place. You've got to redecorate it. You're not getting rent. Before you know it, you've got the mortgage payments to make. And how much money can you beat the 145% a year? Or the 100% a year? Or the 50% a year? No. So here we've got this digital property. There's only 21 million, so it's scarce. Why would you bother? You can make one investment and go to the beach and do nothing versus I need to go and borrow money from the bank, hope the economic system keeps me afloat, hope I keep my job so I can pay the mortgage payments, hope the other one on the first property, I hope the other one, the payments the tenants can keep in their job, I hope, okay, great. Maybe you think you've sorted it out. Next thing that happens is everyone starts working from home and not the office. So they're leaving the city and you've suddenly got 5 apartments in a city and nobody wants to go to the city. Now what do? You can't sell them either. You don't know. So the people who all bought office real estate, they're like, obviously, companies, I just rented to them. They're brilliant. They always pay the bill. Well, everyone's working from home. Real estate's empty everywhere. You still run a lot of risk, but you don't get the returns you can from investing in crypto or even investing in technology stocks. And I like the idea of crypto and technology stocks, even as holding the two and then focusing the rest of the time, just keep focusing on your income, grow your income, build your business, do what you can, because you're investing past that 2030 date. You're investing in your own demise. The acceleration of technology means technology stocks go up. The more they have to debase the currency to pay the debt for the baby boomers, the more your crypto goes up. The more that AI needs crypto to pay itself for the compute and the energy, the more your crypto goes up.
What makes Raoul Pal's thesis so compelling is that it flips traditional investing logic on its head. While most people are told to diversify endlessly and settle for single-digit returns, Pal argues that the real risk today is not owning assets that can outrun inflation. In his view, Bitcoin, Ethereum, and a handful of major blockchain networks are not speculative bets. They're asymmetric opportunities in a world where everything else is slowing down. He draws a powerful comparison to the early days of Berkshire Hathaway stock, when only the rich could afford a single share. Crypto breaks that barrier. It's the first system in history where anyone, from a teacher in Ohio to a farmer in the Philippines, can own a slice of the same wealth engine as billionaires. That's what Pal calls financial equality through code. And while he acknowledges that businesses and real estate have their place, he reminds us that building a company growing at 145% a year, the average compounding rate of crypto during bull cycles, is nearly impossible. The smarter play, he says, is to let technology compound for you. And that leads to a bigger question. If crypto outpaces almost everything else, what's the smarter way to build a life around it? Should you still pour every dollar into a business or a property, or is it wiser to rethink how and where you live, and let your money work for you in this new system? Let's get back to Raoul Pal's interview.
But I'm wondering if I might as well just get a salary job, take all the profits from it, and put it into Bitcoin, if that would likely yield a higher return. And if business is kind of dead compared to just investing your salary into Bitcoin.
You just hold the Bitcoin on your balance sheet in the business. And we're seeing the rise of that too. So you just use your business as your private savings vehicle because you're actually accumulating wealth in your business as you grow it because you own shares. So why not just say, well, as opposed to if I don't need the money right now, if I can just take what I need to live and do this to cover my costs, well, then why don't I just have a savings account within my business, which is my cash balance, and I invested in crypto? Okay, that's kind of interesting. The other thing, there's many arbitrages in this whole equation. One of them is quality of life. What do we work for? Actually, in the end, yes, sure, there's status and, first you got the Maslow's hierarchy of needs. The bottom rung is you need, food, shelter, health, the basic things. And then after that, it actually comes more down to ego and that kind of stuff. But if you want to cover the bottom tier of that, your food, your shelter, but have a quality of life, people don't realize that they can just move. I figured this out. When I was living in London, it was expensive. I was stressed. It was busy. I moved to Spain. And for the price of a 3-bedroom apartment in a relatively nice part of London, I bought a 5-6 bedroom house on 10 acres near the beach on the side of a mountain in a national park. It's like, oh my God, the sun shines, 300 days a year and taxes were lower and the restaurants were half the price of London, maybe a third of the price. So suddenly on much less money, you're living like a god. And it's like, okay, this is possible. People don't realize this. So in America, you can move to different states, and we're seeing people move around. So they're leaving California, whether they come to Texas, but Texas doesn't give you a lot of quality of life, just less taxes. I mean, we're here now, and it's not, I wouldn't say it's the highest quality of life. We're seeing people move to Nashville. Okay, higher quality of life. You got nature around you, stuff like that. Older people tend to move to Florida for some of that. Some people have moved to Puerto Rico. Okay, I get that. Really? There's whole Latin America. You can go and live in El Salvador, Nicaragua, Costa Rica for a fraction of the price. You can have a house on the beach or right near the beach. The cost of food is a fifth of that in the United States, and you can work on your laptop from anywhere. Okay, talk about arbitrage. There's a lot of people doing that in Thailand. So you see a lot of people doing that in Thailand, but there's a whole bunch of countries you can do that with, where you can be connected to the global system. You can live super cheaply. It's pretty safe. And that gives you a much different start than having to think about, well, how do I afford this house in LA? I mean, that's not easy.
Raoul, how much Bitcoin should I buy if I want to be a millionaire?
In 10 years, we're saying the whole market should be worth 100 trillion or more. I actually give that less than 10 years. 8 years, 7 years, let's say. So in 7 years, the whole market's worth 100 trillion. So that's what, 25x from here. So then you just work that back and say, if I put 10 grand in, it's worth 250,000. So if I put 40 grand in, it's worth $1 million. Okay. But Bitcoin is not necessarily the fastest horse in the race. It's the least risky. Could Ethereum or Solana or a mix of those do that faster? For sure. So I've seen people go from 10 grand to a millionaire in less than a year in this space. Now, you're taking obscene risks in something that's probably most likely to go to zero. But, on a balance of things, I think it's very possible to do it. If you can scrape $10,000 together and invest it not so riskily, you'll do that easily. I think. It's 100x return. That's a lot. Nothing else exists like that. Even building a business is bloody hard. You know, if you're going to stick 10 grand to your business, is it worth $1 million? Might be. But you can do both if you can. Now, there are much more speculative areas where suddenly you can do that. And I don't even mind speculation. If you're young enough and you don't give a shit, and you grew up on gaming culture where you kind of get nuked in the game when you screw it up, and so you don't have the fear of loss, speculation is okay. But how I would do it is like, let's say you've got the 10 grand, put 5 grand in Bitcoin, and then figure out, can you take some speculative risk with the rest? So you can't nuke yourself because you've still got 5 grand in something more secure, but maybe you get the opportunity. I tell most people really to put 80 or 90% in the kind of top crypto. This is the whole don't this up thesis. Don't borrow money, because if not, you end up losing your tokens, and your game is to hold them for that 10 years so you can make the $1 million or more. And then you can be speculative with the 10% rest. If you get 100x return, change your life. But the probability of getting that's really, really low. Maybe you lose that 10%. So even if I look at my kind of portfolio, I gave myself, I don't think I even got to 10%. I probably did 5% in stupid shit that was speculative. And most of it has completely failed. And I thought, no, this is a surefire winner. No, none of it. The memes I bought, all terrible. So that's okay, because I've lost 5% of my money, but the rest of the portfolio is up, X 100%.
What Raoul Pal is describing here isn't just a financial strategy. It's a full-scale life arbitrage. He's pointing out that in a hyper-connected world, you don't have to play the same expensive game everyone else does. You can earn in dollars or euros, live in countries with lower costs, and invest in assets that compound globally, 24/7. That's how you create freedom, not by grinding for passive income or flipping rental units that drain your time and energy, but by owning scarce digital property that appreciates while you sleep. Pal's message is simple but radical. You are your own hedge fund. Your salary, your business, your location. They're all variables you can optimize. The one constant is your exposure to exponential assets. He believes crypto will grow from a $4 trillion market today to over $100 trillion within 7 years. That's a 25 times expansion. And while Bitcoin might be the safe horse, networks like Ethereum and Solana could move even faster. His math is blunt. Invest $10,000 smartly, hold it for the full cycle, and by 2030, that could be worth over $1 million. But this opportunity isn't just about making money. It's about escaping the system. As governments print more to sustain aging populations, and as AI and automation rewrite the labor market, owning crypto becomes more than an investment. It becomes a hedge against your own obsolescence, your ticket to financial independence in the digital era. So, whether you're a teacher, a freelancer, or a young investor just getting started, Raoul Pal's message couldn't be clearer. Stop chasing traditional wealth. Start positioning yourself for exponential growth. Because by the time the world catches on, the biggest gains will already be gone. And tell us in the comments, how much of your portfolio are you allocating to crypto heading into 2030? If you found this breakdown insightful, don't forget to like this video, subscribe to the channel. Thanks for watching, and see you in the next one.